Good afternoon, traders. It's Bill Baruch with Blue Line Futures, and this is what's moving. You're seeing pressure across risk assets here today ahead of the weekend, specifically stocks. S&P, NASDAQ, and the other benchmarks all sharply lower, and it all started right after the bell this morning. I mean, it's been developing all week, lower price action all week. Yesterday, though, was a good day, finished strongly, but that quickly dissipated here again at the bell. Obviously, big reason here is ahead of the weekend, COVID-19 cases rising across the U.S., a record surge yesterday, and right on the heels of another number just behind it. So you had Texas and Florida really anchoring those numbers, and it brings a big question to reopening across the country and that demand. I mean, obviously there's been a lot of fundamental questions out there about this market and this rally, but the central bank liquidity has been there for it. And another point is that central bank liquidity has dried up just a little bit here in the recent weeks. So it's no coincidence that the market's lower, but now you also have the additional weight of the question on reopening and these COVID-19 cases rising. So are the fundamentals really there to back this market? And then on top of it, you have tech sharply lower, social media stocks, Facebook specifically, getting hit very hard today on news that Verizon and other companies that are going to start to pull ad spending if they can't guarantee where those ads are going to be and among what other messages they're going to be. So that's another can of worms altogether. But what you got to know is less ad spending is really going to start to hurt those social media stocks. That's really what a lot of things that they're built on is that ad spending. So let's jump into the heat map here. Take a look what we're looking at heading into that final hour. Google, Facebook, really sharply lower, but it's red across the board today. Banks, they passed the stress test yesterday, finished strongly on the session, and really held that rally. Really a big reason why that push late in the session was there, but all of that's gone, and there's a lot of questions, just the Volcker Act, a number of reasons behind the banks and the Fed not allowing the buybacks, limiting dividends. So again, another whole can of worms, a lot to unpack with what's happening in the banks right now, but what you need to know is they are sharply lower here today, as well with tech and healthcare. Had a good session last week and yesterday, and they've given a bit back. So the heat map is really just red across the board. Nothing nice on there except for something like Cisco. You can kind of find a couple pieces, but overall, poor session, and a session that looks to be right at the lows throughout the most of the afternoon. And when you see that, it's something that could allude to a new low ahead of the close, especially ahead of the weekend. But let's take a look at the S&P chart here. And there's a lot that I want to point out because we're right at the 200-day moving average here. So, and it's responded to the last 2 days of the 200-day moving average. But what's also important is you have this trend line from the lows. And that trend line we've talked about in the Morning Express, right around 30.45 area. And we've been below that really since the open. And that's going to add additional pressure and a close below there. Now, what I also talked about earlier this week was the 50-day moving average creeping up on the 200-day moving average, and that providing a tailwind of strength. But you know what? Now we're seeing this market go below the 200-day moving average, and go close below that 200 is going to start to pour cold water over that potential golden cross tailwind. So if we do start going lower, where is going to be support? Well, we do have 29.90, 29.85 is a big level, major three-star support. Below there, you also have some strong support at 29.60 against previous highs. And you have the 50-day moving average creeping up there as something that can encourage buyers. But overall, if this market stays below this trend line and below the 200-day moving average, we really imagine that it comes down here to 28.45 area and finds that gap. There's unfinished business down there, and that should be the target to the downside. On top of that, you have the 382 retracement just below that. And in fact, I love how the 382 retracement is just below that because you can fill that gap, find that unfinished business, get that out of the way, and then not quite get to that 382 retracement. Because I've always said the 382 retracement, if a market's in an uptrend, and nothing moves in a straight line, it pulls back and retests that 382 retracement and then starts to continue to move. So we would remain in an uptrend upon that test, but it would also be a stronger U-turn back higher if it didn't quite get there. Same thing to the downside. Use that 382, downside, it comes back up and consolidates. So those are the levels I'm looking at heading into the final hour today, heading into the weekend and heading into the start of next week. But what's also important is the NASDAQ. It's holding very well out above the previous record highs, and that's a bull market out above the record highs. And basically 15 or 16 sessions it's been out above there. It's been only 2 sessions it hasn't closed out above that previous record high. So ultimately, those are signs of a bull market. But again, you got tech down sharply here. Is Facebook leading the way lower? And we have that line, this being the line. It's going to bring a lot of support. The first initial low today actually responded against major 3-star support, about 98.50. Market turned higher. It looks like it could be testing down there for a second time. And a second time would allude to lower prices. So watch that NASDAQ in that previous record high as sort of a barometer of strength. And then now moving on to crude oil, another one here, a similar trend line, the S&P, and overall it's held it for now, and it's responded off of major 3-star support right below $37 this week. But if we start closing below that trend line, below about 36.5, door is open down to about 33.5. So keep that in mind. That is that 382 retracement and an area of consolidation, quite a bit of volume that traded there. And then as you're seeing these risk assets get hit, what's moving higher? The 30-year bond. And we like that 30-year bond. We think it's going to be breaking out. We've talked about this 50-day moving average quite a bit. So what it did here is it sold off and really hit what became a breakout trend line on the inverse side of it. And now that's been a lot of support where we've moved out above the 50-day today. It's not quite holding out above there, but watch this. And now you have a trend line of support. Now, we don't like trading off of trend lines, but we like to use them for momentum. Where is the path of least resistance? And now that this is signaling the path of least resistance higher, overall, where would we be targeting to? I think you can look at something like this to be a target to the upside. And not, again, we're not trading off of it, but you can use trend lines for targets. I wouldn't use them for entry points. But this would be a great area to see about 181 in the 30-year on a move like this. But again, you would have to see additional risk off to move the 30-year higher. Now, this is the inverse side. This is the 10-year on the notes. And I want to show this because the 10-year futures, which are the prices, the inverse, don't necessarily show this. You have this high, this stretch of higher lows in the 10-year yield. And so the yield, we're at the lowest level in the yield since May 22nd. But you don't have a trend line like this. Breaking below there and then breaking below that 50-day moving average is now opening the door for a path of least resistance lower. And that's going to be a tailwind behind the 30-year. Now, what it's also lifting here today is gold. Tremendous week for gold. It made a new 8-year high on Wednesday. But here's the good thing for gold. Finishing strongly today doesn't really leave it so much of a spinning top on the week. And I'll show you the weekly chart here in a second. But this is a continuous chart for gold. And you have that trend line that broke out above, and now it's support. So again, this was actually a good area to look at as support, but this 1750 area was the low of the week. It hit it today, 1754 the low of the week. Big retracement level down there, and you had obviously a little bit of a gap area from the close of last week. So a lot of support in 1750 region. That was our major 3-star support this morning. We said that's where you want to be a buyer, and that would have worked. Now we're moving quite higher here today. Good finish for the session. It's already settled. So even whatever happens here in the last final hour and a half or so, it doesn't matter. Settlement was higher here for gold. It matters, of course, but I mean on a settlement basis, this was strong. It negated the spinning top here on a weekly, and ultimately paves a path least resistance higher. It's a fresh-looking chart. This is a breakout in gold, it looks like. It needs to get silver to join. Lastly, let's finish with some of the currencies. The euro, again, the 50-day moving average creeping up on that 200-day moving average. A lot of these risk assets are getting that move because they've recovered so sharply. So the 50-day moving average creeping up on the euro. The euro is 200-day. Overall, it's staying higher up here. This is, we fundamentally think the dollar should be higher than where it is. This is starting to prove us wrong consistently here. But overall, we would like to see this thing come back in a bit. Again, I think you can wake up any day and this budget that the EU is trying to put through could be just dissipated. It could be gone, and it's going to wake up. You'd wake up and you see that, and the euro be down a penny, 2 or 3 cents back down here pretty sharply, I imagine. Now, these are risk currencies. The Aussie, I think the only disappointing thing about today, and the fact how sharply lower the S&P is, how sharply lower the other risk assets are, is the fact that currencies are not following. So you do have this trend line violated in the Aussie dollar, and it helps pave a path, retest back to the 200. But again, you have this 50-day crossing above the 200, which could bring a bit of a tailwind. You got to see what it may or may not do here in the S&P and other risk assets. But again, if the 50-day crosses above the 200, it's going to start to help support the Aussie. Regardless, we do think that it should go back and test about 67. We're not using the 50-day and the 200-day as a major reason to be in a position, but we do think the Aussie should go lower. I want to point that out, that it's going to keep it elevated until for some other fundamental reason that it could break below it. And there's obviously landmines down the road here through the economic calendar. Chinese manufacturing data is on Monday. And then lastly here, let's finish with the Canadian dollar. This never got out above the 200-day moving average, and in fact, we're starting to look at this Canadian as a place to be. We looked at the Aussie initially months as a place to try to fade it, but now it looks like the Canadian is going to be the one that it never got above the 200. It stalled at this gap, and then now it's starting to turn down a bit. So one of the trades that we've done in this Canadian dollar, now the Canadian is trading at 73 right now. One of the trades that we've looked at the Canadian dollar here this week is a 1x3. You're going to sell the 73 put in for September one time and buy the 72 put 3 times. And what this is, it costs anywhere about 60, 65 cents. It's a little higher now here today, but about 600 to 650 bucks. What you're getting with that 1x3 is you're getting a 50 delta here right now. But if this thing starts rolling over, you're going to get at least a full delta, a full future delta. You know what your risk is on the trade, and it continue to pick up to the downside because ultimately, again, once that short 1x1 spread, you have 2 in the money puts down there, and that 100 delta is going to continue to feed on it if this thing can roll over. Very low risk, high reward trade on there. And if you want to talk about them more, give us a call. We're here to help. Any of the assets classes here, we're here to help. 312-278-0500. Remember, though, futures trading involves substantial risk of loss. It is not suitable for all investors. Thanks a lot, and have a great weekend.